how to find multiple deals in your database that you probably don't even know are there. Hey, I'm Scott Beckford. This is I Love Mortgage Brokering podcast. And today on the podcast, I chat with my friend Matt Imhoff. Matt is an absolute master at calculating and understanding mortgage penalties. And with the current rate environment, how much rates have been changing, there's lots of opportunities for mortgage brokers to save their clients money, get them a lower rate, and also there's situations where you're going to lose money, and it's way more complex. So any of my listeners, if you're one of my US listeners, you probably think, what are these mortgage penalties? Why do they matter? In Canada, the Canadian banks have mortgage penalties, and typically up to 5 years. And if it's a fixed rate, the penalties can be very large. And it's just one of the things I always say is that Canadian banks, they're really good at not losing money, which is why they do it. In any case, if you are a Canadian mortgage broker, you're going to listen to this podcast because Matt and I discuss a bunch of real cool tricks and tips about how to do that. And you can also reach out to him to get more help. Hey, so before I jump into that, let me give a shout out to our title sponsor, Finmo. Finmo is a Canadian mortgage application, document collection, submission platform designed specifically for Canadian borrowers. It's very easy for borrowers to use. It's got some cool features like Smart Docs, knows what docs your client needs based on how they fill out the app. It's got smart submission notes, pulls key data from the app, and it's connected to Lender Spotlight, which is the best tool for searching rates and guidelines. They have over 8,000 of them in there. Check them out at lendesk.com/Finmo and just get a demo. You've got to just see it in action. It's kind of like taking it for a test drive, and I promise you, you're going to love it. Let's jump into this conversation with Matt. Hey, Matthew, welcome to the show.
Hey, Scott, thanks for having me.
Hey, so I'm excited to chat with you. You are a ninja when it comes to mortgage penalties. And in the current market, that is a massive advantage to understand how penalties work. So maybe before we talk about some of the things that you're noticing with penalties and how you guys help clients and stuff, borrowers and clients, tell me a little bit about yourself and how you got in the mortgage biz.
So I've been a broker, it'll be, I guess it's just 9 years now. So before that, I was full-time with the Royal Canadian Navy. You might be able to see the crown for my uniform over there in the background.
All right, what did you do in the Navy?
So I was a Marine technician, reserves. So I sat in a control room. We had to provide propulsion and power to the ship. So essentially, we were the heart of the ship. And just if they needed to go faster, we'd turn on more engines. If the lights went out, you had a certain procedures to go through. You know, I always like looking like what's the biggest priority? Like, what am I up against? Like, what do I need to go and do? And just deploying, our support team or rounds persons to take care of that.
Right. So you were kind of like in the old Star Trek. You were Scotty. She can't take much more of this captain.
We need more. Yeah, exactly. We need more power. And so that's the nice thing there with the officers. They'd either say like, obey telegraphs, which means like, we're going to hit something, or if they would, the ships we had, they're azipods, so there's no rudder. You just can turn the pod whatever direction you want to go. They would stop and feather them. It would let us know, like, don't damage machinery or personnel in order to restore propulsion. So it's kind of nice, like, knowing right away, like, is it an emergency? We need propulsion back up, or can we just float around in the middle of the ocean and get it back up when you can?
So are you meaning that, is this like, if you're going to hit something and they're basically, whatever you need to do, just stop forward so that is that what you're meaning? Like, is it kind of like,
so if let's say we were going to hit something, the first thing after losing propulsion, they would make an announcement. They'd say MCR obey telegraphs, which just lets us know, like, if we have to jerry rig something or like start.
Oh, I see. So they're giving you a priority of what to do in what order in terms of like, if you've got to do repairs, do it in this order. Is that what
exactly? Or so we know if we have to risk like life or limb, or whether it's like, hey, it's great you threw that rounds person on top of that engine to to get it started up. Well, we were just bobbing around. Like, it just lets us know what the priority is. Like, Are we in danger, or is the priority preventing injury and preventing damage to machinery?
Right. That's kind of, when I was a paramedic, we'd have code 3 or code 2. So code 3 was lights and sirens blasting and get there as quick as you can. Code 2 is don't like stop for coffee, but you need to, you basically go with the flow of traffic, and it's not it's not life threatening to nobody. Because when you drive code 3, you're putting other people at risk. The public is at risk. That exactly. You could cause an accident. Yeah. So it's like, is it, and it's a low percentage, but is it worth putting the public at risk because this other person is very ill? And so it's kind of the same idea, but maybe we can tie that into your mortgage business. So with like, one of the things that I've known you for a long time, and you have this sort of savant ability, interest in mortgage penalties. If you're in the U.S., by the way, you'd be like, this is kind of boring. There's nothing for me to do here. People, I'm out. But because there are no penalties, in
you
most
would
mortgages.
find something else to go and do. I mean, I look at it, there is an art to it, but it's a lot simpler when you just break it down to the basics. Like, I'm not advocating for every lender to do it the same way or to get rid of interest rate differentials. It just really, the basic, the nuts and bolts of it are, is the penalty what it should be, more than it should be, or less than it should be? That's what it really comes down to. And looking at an interest rate differential, kind of forgetting about 3 months interest and just thinking, is the interest rate differential more than it should be? Maybe a lender that offered a lower rate, but calculates things in a way where your IRD is going to be a bit higher. Is it what it should be? So it's like, we lent you the money at 5%, we can get 4%. You owe us 1% per year for 4 years. Or is it less than it should be? Maybe a detachment that they're telling you that they can earn less, earn more interest, and therefore your penalty is 3 months interest, and you can move to a product where it saves you money. So it just really comes down to that.
Right. Okay. So maybe let's like dumb this right down. I'm assuming most people understand this, but tell me like I'm 10. I know what this is, but like define IRD to me like I'm a 10-year-old so that I can understand it.
So it's the difference between what the lender has lent you the money at and what they say that they can get for the remainder of the term.
Right. And there's a lot of assumptions baked in there, and they build in obviously a margin because they've got costs. So, it is what it is. And that you would agree that lenders do it very differently. Each lender has different ways to calculate it, different, like, what would you call that? Like different reference points or benchmarks they use to calculate it. So it can get very complex. It is not simple. And a lot of times I've found that people at the bank can't tell you unless they actually got to get a quote. They can't just do the math themselves. It's like, no, I actually got to go. Somebody else has got to tell me the penalty. Is that what you find?
Well, the issue is that they make it hard to determine what rate that they need to be quoting for the comparison. So you look at, if we're dealing with a bank and you got a posted rate and a discount, and depending on the date that you closed and what your rate was, they're quoting a different rate for you for 4 years remaining than maybe someone with 3 years, 11 months remaining, or 4 years, 1 month remaining. So if we just ignore all the other noise and just come back and say, if I lent you the money at 5%, okay, what rate are you saying you can get? Not what posted rate, not what discount. We lent you the money at 5%. We say we can get 5%. We have an interest rate difference of 0. Anything times 0 is 0. You pay 3 months interest. If we tell you we can get a higher rate, we lent you the money at 5%, we can get, let's say, 6%. We have a negative interest rate difference, a negative interest rate differential, which is less than 3 months interest. So it all comes down to
but you would still pay the 3 months interest in that scenario,
exactly,
right?
Yeah, you still pay that no matter what. Yeah. It comes down to it. They have to tell you that they can't earn all the interest. Oh, we lent you the money at 5%. Oh, we can earn 4.5%. And then depending on how much term you have remaining, that interest, whatever gets added up, may or may not be bigger than 3 months interest.
Right.
If you have a lot of
based on the number of essentially months, you call it years, but it's really going to come down to, and then that time left over is going to be what they're going to determine what rate or term they're going to compare it to, right?
Yeah, no, I mean, in this case here, if we're already saying what rate that they're using, we've already gotten to that point, right? So we know right now shorter term rates, whether it's posted rate or contract rate, are higher than longer term. Mm-hmm. So if you progress enough through your term, you're most likely being told, hey, we can earn more interest. The interest rate difference is negative. The interest rate differential is negative. You owe us 3 months interest, but you're not necessarily going to return that mortgage with 1 year left because you can't make up that 3 months interest in a year. You just go and finish your term, and then you move once you're closer to maturity.
Right. So what's the biggest interest rate differential that you've seen? I mean, I've seen some big ones over the years, but I'm curious what you've seen because you're in that world a lot more.
So it comes down to if a lender's saying using bond yields. We had it where during the pandemic, I don't know what like a 1 year or 2 year bonds were, was like 0.5%, 0.35, something really low. So if they lent you the money, say on a B lender, 3% or 5% or whatever it was, they're effectively saying they can only earn like 0.35%. So you're owing them like 90% of the interest to the end of the term.
Wow.
Right? So that's where for there. we're seeing a lot, especially if, say like an RBC, if you got a 10-year fix at peak 10-year posted, you're probably being quoted a penalty of 6.5%, 7%, just based
of the
on
balance.
of the balance, right? Because you think if the rate has come down, say 0.6, 0.7%, you have 9.5 years remaining. You basically have a big penalty until you hit 5 years into the term, and then the Interest Act comes to your rescue and reduces your penalty to 3 months interest.
Right. So that person. Okay. So you've created some tools around this and coaching and stuff for brokers. So walk me through some of the ways that you guys help brokers close or find more deals. Because that's kind of this is all great, but it's like as again, if I'm a salesperson, I'm like, okay, how does this make me money? And so what I want you to tell me is walk me through some scenarios where you do that.
So we'll look at this. So right now, on September 17th, 2024, because people might be watching this a bit later.
Yeah.
Right now, say, I know they're our lender partner, TD Bank. They've detached posted rates from actual rates. If we look at peak bonds and peak rates, we're like 1.5% off of peak bonds, peak rates. Okay. But they've only lowered their posted rates 0.3%. So if I have a client who got, say, a 5-year fixed in October of last year, they have, about 4 years remaining. The story here is, let's say they got a 6% 5-year fix. The story that TD is saying is we lent you the money at 6%, we can get 5.7%. Because the difference between the posted rate when that mortgage closed and the
so the penalty would actually be just 3 months interest.
3 months interest, exactly. But if you look at your rate sheet, you're like, hey, it's saying 4.79 or even lower potentially for a 4-year. So if we look at that mortgage there, and this is where with banks just disclosing what your penalty is if you ask, like they don't even tell you what your IRD is when it's greater than 3 months interest. So I look at that mortgage and I just think the IRD is like 1/5 of what it should be. So in this case here, that's a mortgage where, hey, client, let's return this. If I can get you a rate that's like 1.5% lower, your break-even point's like 1 year. You keep the new mortgage for 1 year, then you save for the remaining 3 years. Am I getting them a new 5-year fix? No. Am I moving them to a variable? Maybe if they see enough value and they know like you're not guaranteed to save the same amount, but this might be what pushes them to go variable. Or a client's like, oh, we're going to sell in 2 years. Well, maybe you move to a 2-year, or maybe like there's so many. It's like you're lucky. Your penalty is 1/5 of what it should be. If they were charging an IRD based on 4.5%, I wouldn't be saying TD is an unfair penalty lender. I would say they're charging the market rates. Right? Mm-hmm. If they were a monoline and rates had come down, they'd be charging an IRD based on about a 1.5% difference for 4 years. So right. That's where I see value with TD. And I look at this, and it's like when you think of poker, you have a winning hand, but you don't know. And so a lot of times when you're playing with your friends, you just say, put your cards down, the cards will speak, or here's the card ranking. Hey, I got 5 in a row, but they're not the same color. I don't know if I have a good hand. And so that's where someone with
it's pretty good in most cases.
Yeah. But then on the flip side, what happens is for new mortgages, they're closing with discounts that are much bigger than they should be. So that's where for here they close. And then let's say this reverses. Let's say posted rates drop 5 times as fast as actual rates. Then when they go get a quote, their IRD is going to be 5 times what it should be. Right?
So I think I find interesting about mortgage brokers and guys like you is that if there is we are really good at finding, a glitch in the matrix that we can exploit for our clients' benefit. That's not the best way to explain it, but you know what I mean? It's like, if there is something that we see, we're like, oh, this could help a lot of clients, and you can find those things. And the reality is, it's good that you timestamp this, is because these things can change on a dime.
Yeah, absolutely. We check it every day.
Yeah, it could change on a dime. So there's one example. Okay, so like the tool that you guys have put together. So if I'm a mortgage broker, how do I use it? I know that we're going to talk about it, not see it. So like maybe explain to me. So in
this case here, we want to quickly identify IRD or 3 months interest. Like a lot. And that's the flaw here, is if you don't understand something, you need to be checking it. Like if you don't know what time it is and you're going to be late, you check what time it is. You don't just go and think, well, I checked it 20 minutes ago. I think it was 20 minutes ago. You check it all the time,
Right.
Like So that's where for here with this, there's people that are just disqualifying themselves or brokers that are disqualifying mortgages by not understanding penalties, but being like, oh, I think I understand them enough to know it's a big penalty when
and
it's
then
not.
then they don't even proceed or even attempt it.
So they don't even they don't even go and look, right? So
Right.
that's the thing here. Always check, right? Now the problem with the lenders is, and this is something that I'm hoping with with getting exposure and like what the tools we're building, is the lenders won't tell you what your IRD is unless it's greater than 3 months interest and unless you ask. So you could be right here asking every day, then stop asking. They're not going to be like, hey, Scott, we noticed you didn't call today. We're just letting you know we lowered our posted rate. Your penalty is now $4,000. Yesterday it was $3,000. They're not going to do that, even though you call them every day at 8 o'clock in the morning to ask for what your penalty is. So for them, they're just disclosing the minimum. And that's where for here with brokers, we're getting the first tool that we're going to be launching, and hopefully it'll be next week to the brokers that are already part of Prepayment Penalty Mentor, is just a basic, is it an IRD? Is it not? Is it IRD or is it 3 months interest? If it's 3 months interest, then we're just telling you what has to happen for it to be more than 3 months interest. Oh, this posted rate has to drop 0.2%, 0.3%. And then you can map out, like, is the client planning on selling? Is the client planning on moving? How much room do I go and have? And then that's where you go into more advanced calculators where you're like, okay, let's put in the mortgage amount. Let's put in all the details and confirm, and let's go and create a nice PDF, and let's go. And then the next calculator, let's track it. Let's have it where it's automated in our system, where we can go and see where the IRD is. Did time cause the IRD to go down? Did a posted rate change?
Yeah, okay, that's a brilliant idea then. So people can, it's because it's a constantly changing number, and there's two things I think of. One, remember when Facebook came out, their initial product was hot or not, and it was just like, and it's kind of like what you're doing. Is it hot or not when it comes to
exactly?
So that's a simplified version of that. But then the second thing I think about is that because of we got sirens in the background. That's a code 3 right there. You're listening. That is a code 3. That means that somebody is a health risk high enough that it's okay to put the public at risk. But
and also interrupting our podcast.
Yes, right? I mean, whatever. I hope that whatever's going on. I found that most of the time
they're okay.
Yeah, most of the time it is, but they don't, like, if they're not sure sometimes, especially if it's to do with like heart attack, stroke, time makes a difference. Like if you have a stroke, for instance, the time it takes you to get those meds can mean the difference between you being functioning again or having somebody have to feed you, right? Like, so it's pretty important.
Oh, exactly. Like, always err on the side. Like, I would rather rush to get the information we need than be like, oh, we have a bunch of time.
So, okay. So I'll go back to this now that they're gone. So basically you have one ability for somebody, if I'm a mortgage broker and I got clients, I can put my data in there or somehow where I can, am I following this correctly? Where you can actually monitor this so that I can be, this person, because the other thing that can happen, maybe give me an example of, because I've talked to Jim Chalukas about this in the past, but where like at 9 months, it can change, like 6 months. There's certain milestones that most brokers are unaware of that all of a sudden
once you're compared to the 6 month term,
right?
And like lenders 6 month posted tends to be higher.
Yeah.
So that's where once you hit that point, and that's where for us, like we have it with some of our advanced coaching, we're like, hey, brokers, make connection with realtor partners and go and say, let's plug it in, let's monitor. Hey, I know the client wants to sell within 1 and 3 months, but if we get a closing that's 3 months, well, now we're going to be using this rate here, which drops it from a significant IRD to 3 months interest. We've estimated saves the client $5,000. They might accept an offer that's $2,000 less closing on that date there than early. Or if we have it too, we're saying, if you go to a listing appointment, here, give this card from the broker. We're going to do a penalty analysis. We're going to go and monitor. Because you might get someone that talks to the real estate agent, they've confirmed with their lender that's 3 months interest, and by the time they are about to sign the listing agreement, they check with their lender again. Oh, it's $20,000. You know what? We wanted to sell, but let's just go and wait. Whereas for us, we'd go and say, well, it's this unless this happens. If you're interested in selling over 3 months, the smart play is to pay the penalty, go into an open. Sure, it's going to cost you this, but it saves you money as long as the posted rate is not lower than this. You know?
Right. Yeah, that makes a lot of sense. So yeah, there's a lot of ways. If you and the other way I think of this metaphor, back to tell me like I'm 10, is like your client is playing poker against the bank, And you, with the way you structure, you can see the cards to help coach them. Because otherwise you're like, you have no idea. Like, they have a winning hand. I don't know. They might have a terrible hand, but they basically flip the cards over for you. You look at them and go, oh, you got a winning hand now. You didn't, but now you do. Or you're going to, and then you can then advise them on when you should be selling your place, when you should be, maybe you, like you said, refi before you sell or whatever, so that you actually, because the penalties in Canada, back to what we talked at the beginning, are significantly, can be significant, and can be the difference between somebody wanting to, move properties or not, because of the size of penalties that we can be talking about.
Well, exactly. And we're just getting a snapshot in time. We're like, oh, what's my penalty today? And the lender can't even communicate to you, like, hey, what would have to happen for it to be 5,000, 10,000, 20,000? Like, we'll have a calculator where it's like you put it in and you go and say, well, what would have to happen for it to be 5,000? So like, we'll go based on your balance, and we're like, this posted rate would have to drop 0.5%. And then we could maybe determine how likely that is over a period of time. Oh, what would have to happen for my penalty to be 20,000? Well, your balance is 200,000. They'd have to lower the posted rate 2.5%. We don't really see you having a $20,000 penalty over such a short period of time, because that would be 10% of balance. You'd need to have like 5 years with at least a 2% difference. And if you have 3 years, like, we can disqualify, those fears, because we can go and say the likelihood is pretty much impossible. So essentially what we want to go and do is have it. So there's a couple of things. So we want to help brokers make better decisions. If a client's like, hey, I'm getting a 3-year fix and I'm selling in a year, maybe a TD Bank 3-year is riskier than a First National 3-year. Or maybe you need to consider a variable rate or a 1-year or a HELOC. We're like mapping all these different things out, because there are people getting 3-year bank fixed rate mortgages today that mistakenly assume their penalty will be 3 months interest in a year, when it's virtually guaranteed that it's going to be a significant IRD. There's so much room for these posted rates to drop. So make better decisions. We want to have brokers be able to give their clients a North Star, where we're like, hey, we call it the IRD trigger rate. What does the lender have to do immediately after closing for your penalty to be more than the minimum? And we can tell them, oh, this posted rate's a drop, this contract rate. Give the client all the resources, and then that's where for here, then we enroll them. Hey, we're going to monitor this, right? We want to make sure. Do you remember the story about the woman with the $30,000 TD penalty?
Yep.
Right in the middle of the pandemic there. So for her, she got the mortgage, 5-year fix, 3.71%. She got it either in September or October of 2018. And what was baked into her mortgage that we would be able to go and see was that at 53 months remaining, TD Bank was set to tell her that they could only earn 2.01%. That's the story that was baked in there. So you look at it. Would we recommend a monoline? Maybe she can't qualify. A variable. We would have recommended a 4-year fixed. And what do you think her penalty would have been if she'd taken a 4-year fixed at 3.71% instead of a 5-year fixed?
I have no idea.
3 months interest.
Right.
Because the thing here is the biggest gap between posted rates. Her 5-year post was 5.59. The current 4-year was 3.89%. So I look at it, for me, I don't like selling bank 5-year fixed rate mortgages. The analogy I'll use is I might be pro gun safety, but anti, like, hey, don't buy a gun. But if you're going to buy it from someone who's all about the safety, right? So for here, I position myself as the safest broker you can buy a bank 5-year fix from, because not only am I going to show you what can happen and how easy it can happen, if you buy that product, I'm not going to be like, don't shoot your eye out and just not help you. I'm going to go and say, as your IRD increases, I'm going to warn you.
Right.
And that cliff at 53 months, well, I'm warning you at 55 months, 54, email, text, phone. And then once we've hit that, I'm like, how do we mitigate it? We were seeing 4 years of an IRD greater than 3 months interest. And so that's what was baked in there.
Mm-hmm.
The person she bought it from TD isn't equipped to spot that out.
No.
If they were, they probably wouldn't be working there. And the lenders push these products as they go and say, well, this product's going to be super profitable for us once they hit that triggering event, 53 months. And then she's either paying that interest rate in which they make money, or paying, in this case here, an interest rate differential that was like 5, 6, 7, 9 times more than it should have been. And then they're making money. And then those people are subsidizing the interest rates and the cash back for those.
for the
And
other
that's where you
people.
have to see how people win and how people lose. I think we're overly optimistic that the product selection we make is going to be the best one, and that's where we're helping brokers help their clients make better decisions, and then we're monitoring. And then with this as well, we're going to push to the client, hey, want to confirm these details are correct?
Yeah.
Because if a client made a $100,000 lump sum payment, that changes the number.
Yeah.
That changes what their amortization is if they kept their payment the same, or it doesn't if they reduced it. And so that's where for brokers, we'll be able to identify these IRDs are more than they should be. So warn the client, help them to mitigate. These ones are less. Hey, maybe there's some opportunities.
Okay, so I got one question for you. So give me one tip or trick, because you kind of talked about this a little bit earlier on like that 6 month and 9 month thing. Give me one other tip or trick on penalties that most people don't know, or that where brokers mess up.
I mean, a big thing is not paying attention to the posted rates, right? So what discount that they receive. So we've been tracking bank posted rates for 2.5 years. So we know kind of who's on whichever IRD train.
Right.
Because like if I give an example, say like a TD Bank 5-year fix from October, it doesn't matter what rate you have. The story that they're telling you is that they can earn your rate minus 0.3%.
Right.
Okay.
Oh yeah, there's an example. So okay. So how did you figure all this out? Because the math is not clear. Like I can tell you that like it's not like from a consumer's perspective. So how did you guys manage to like piece this together? And because every lender does it different, so that's the other part. Like there's not just one way to do it. They have their sort of. Yeah.
It's about reading the rules. Like you think about it, you might play a board game. Would you say the people that read the rules of the board game have a better chance of winning than those who don't?
Right. Yeah. Fair enough.
But the issue here is that the rules aren't just in the commitment or on the website. They're in the mortgage loan agreement that the client signs with their lawyer that most brokers don't review. So for me, I will not send a lender of business unless I've seen every single document that can be placed in front of the client. So I'll look at it. I know stuff about Scotia because I read the fine print and like, oh, this makes sense in terms of how they set their posted rates and how they confirm these details. Okay, this makes sense. Here's how they're disclosing it. A lot of lenders don't put the posted rate and discount on their commitments. A lot of lenders, if they're updating their rates, focus on the contract rates and then either don't highlight or don't put the posted rates. And also too is unless you're looking at what it was previously, you don't know what the change is. So so I look at this stuff here. It's, we're either going to have it where people overestimate their penalty or underestimate it. And also they don't know where they're at. So it's about reading the rules, and then it's just about thinking for a second. So like, if we look at mortgages, we have open mortgages where we understand what the game is. You pay a higher rate, there's no return fee. But let's say you and I were going to start our own lender, and let's say we were going to offer the lowest rates, but the penalty was you had to pay all the interest until the end of the term.
Right.
Okay, so that's the other end, right? We could be offering 5-year fixed at 3.5%. How do we make money? Well, we lose money if people finish their term. We make
but we
money.
know a percentage of them are going to break, and then we make
Exactly. So if we think about that mortgage there, we're like, okay, all the interest to the end of the term. If someone has a lower amortization, they're going to owe less than someone with a higher amortization. So that has an impact. In this case, if we're charging them all the interest, we're adding everything up. So that's where for there. But when you think about that mortgage, when someone has 3 months left, what's your penalty with 3 months remaining in your term?
Well, usually it should be 3 months interest.
Or interest to maturity.
Right.
Right. So you look at that. And any other lender, so like let's say the TD Bank there with the 3.71 and the $30,000 penalty, after 6 months, they were basically charging her like 75% of all the interest to the end of the term. Right? If they wanted to charge her all the interest, they had to say, we lent you the money at 3.71, we can get 0%. But if they said 0%, they'd get a little bit too greedy, and then there'd be so much attention on this, and then rules would get changed. And that's where when I look at this, because nobody's really focusing on the rate that they're saying, the 2.01, they're focusing on the posted rates, the discounts, the contract rates, how the
Well,
banks,
and people tend to always they go, oh, that won't be me. I'm not going to need to move, not realizing they're going to get divorced, not realizing the job's going to get transferred, not realizing
yeah.
I get sick and now I gotta sell. All of these things that can come up that'll force you. My kid, I'm older. My kid's has a kid and got to move in with me. Now I'm going to move and find somewhere else to live. There's 100 reasons why you will not finish your term, and everybody thinks it won't happen to them. Right.
Well, exactly. And so let's say for that client, let's say she didn't return her mortgage and we were tracking it. If she reached out and said, hey, Matt, I see rates in the high twos, I want that. I'd go and say, well, the lender's saying they can only earn 2.01%. So this only makes sense if we can get a rate that's lower than 2.01%, or you have a ton of debt, or you have to do something. Why would we pay a penalty based on 2.01 and jump to 2.95? It doesn't make sense. We would pay a penalty based on 2.95 to jump to 2.01, but we'd have to make sure we're adding risk. At what point do we recoup the penalty? What's the value of lower payments? And so we try to, not only do we make it easy with the calculators and the tracking, we want to make it more when you're looking at it and saying, well, what rate is the lender saying they can get? Oh, it's 5%. There's 4 years left. Well, can I get a rate lower than that? Can I lump in some debt? Does the client value lower payments? Well, even if I could get a new 5%, and let's say all the other costs were there's cash back from the lender, you're basically getting a free refinance as long as you finish the term. And the benefits that you're getting are lower payments and consolidating your debt.
Right.
If let's say you get a lower rate than that 5%, then you're breaking even at earlier points. So we try to have it where it's we just ignore all the noise and what rate did they lend you the money at? What rate are they saying that they can get? And can we beat that? If we can, then you would do it all the time.
Oh yeah. Where can people find out about you?
Okay, so the first place is on Facebook. So at Meticulous Brokers is our Facebook group. We answer a lot of penalty questions. I share some insights. And then our website, www.penaltymentor.ca. And that's where you can learn about our offerings and our programs. In this case, go on the website and check it out.
Right. And awesome. Well, thanks, man, for coming to chat with me. I know you got hundreds of brokers that you guys are already helping, and I think it's a great tool and a great resource. So thanks for chatting.
Hey, thanks for having me, Scott.
Hey, thanks again for listening to my conversation with Matt. Hopefully you got inspired about some things you can do with your business. And what I love about guys like Matt and anybody who gets really hyper-focused on solving one problem really well is you can niche right down like Matt has done and end up creating a fantastic kind of side business for himself, but also a fantastic resource for helping his own clients. So I encourage you to check out Matt if it's something that you think you could use. And if you have any clients, you're probably going to need it and use it, especially in this rate environment. Check them out. Thanks again for listening. And as I always say, there's no problem that hasn't already been solved. Your problem is who's got the answer. Hopefully this podcast provides some of those answers. Thanks again for listening, and I will see you on the next episode.